Hello all and welcome to today's Risk Scout workshop, navigating compliance challenges for FinTechs. We are so excited that you're joining us here today. Before we dive into today's content, let's roll through some quick housekeeping items. Risk Scout will be sharing all of today's workshop resources, including the slides, the handouts, and the recording in a follow-up email, so be sure to keep an eye on your inbox. We also want these sessions to be as valuable for you as possible, so we encourage you to ask any questions that you have throughout today's session in the questions section on the webinar panel on the right side of your screen. We also have 3 accompanying resources that we encourage you to follow along with today, located in the handout section. Each handout is labeled 1, 2, and 3, and the order that we'll be going through them. So we encourage you to go ahead and download those and pull them up when the time comes. For those of you that are joining us for the first time, Risk Scout is a team of former bankers, regulators, and industry experts that have joined together to help community financial institutions unlock complex markets to increase deposits from their own backyard. Through both software and services, Risk Scout reduces the time, effort, and uncertainty around expanding into new markets, so you can increase your footprint without having to open a new branch. If you're interested in learning more, visit riskscout.com and get in touch. Today's session will be led by Kristen Parker, Risk Scout's Vice President of Compliance and Operations, as well as Ryan McInerney, Risk Scout's Product Strategy Principal. Prior to joining Risk Scout, Kristen worked with both fraud and BSA teams, where she successfully created and implemented one of the first Federal Reserve Bank approved hemp onboarding and ongoing monitoring programs. Ryan McInerney joined Risk Scout in the product team after working as a national bank examiner with the OCC, where he helped to identify changing industry trends and risk conditions, particularly around compliance and commercial credit. We are very excited to have them both joining us today. Without further ado, I'll go ahead and pass it over to today's presenters to take it away.
Hi, everybody. Good to be here with you. I'm Kristen Parker. I got the intro from Ethan, and I'm so excited to be here and walk you through this FinTech space. It's a space that I've been personally working intimately in the last couple of years, helping financial institutions set up new verticals at their institutions, as well as shore up existing FinTech verticals. So intimately know from varying size institutions what it takes to run a FinTech program. So I think it's important that you get that background and understand where our views of this is coming from. Ryan?
Hi, everyone. Great to be here. Ethan, thank you for the introduction. Equally excited to start going through some of this information we have on FinTechs. We've seen when I was on the regulatory side, just that kind of growth and how so many different financial institutions started to leverage them. So happy to provide our insights here and answer any questions y'all might have.
All right, so this is a good interactive webinar or workshop rather, that we like to work through with you guys. Feel free to type in questions in the question box throughout the presentation, and if you have questions, we'll be happy to answer them at the end. I think it's important that as we go in here that you understand, while we're going to go as deep as we can, we have a limited amount of time, and the risk assessment in the policies area is pretty comprehensive. And so we're going to hit the highlights, but you are always welcome to reach out to both Ryan and myself to take a deeper dive into those spaces. We did spend a lot of time working from a BSA AML perspective from the beginning, but as we've worked with financial institutions over the last 6-8 months and helping them set up verticals, it's really expanded outside the BSA AML space for the risk assessment and the policy. So we help you really think through all of the pieces of the puzzle that you need from varying different department perspectives. And we say all of them, but again, it's dependent on what vertical that you're wanting to bank within your FinTech space. So we'll talk through all that, but we need to start at the basics. So why FinTech? FinTech is it's becoming more and more talked about at every institution. There are varying different approaches for FinTech. There's also the term banking as a service, kind of interchangeable in some respects, but essentially a FinTech is there at your institution. If you are banking a FinTech, they are using your charter to do some type of support or offer services that would otherwise your institution does not offer, or maybe they do offer, you do offer it, but it's just a different approach to offering it. So the FinTech space can quickly support and achieve strategic objectives if you're trying to reach new markets that you traditionally would not have an easy way of reaching, and you don't have the technology staff to do so. A FinTech relationship could be very fruitful for you guys, for your own customer base, and to obtain new customers or members. And supporting that, when you provide the access to new markets, you get different consumer types, you get different businesses that you normally maybe wouldn't have, or it may have taken you years to, while this FinTech has already an existing customer base that they are serving, or have a way to quickly ramp up a certain customer base. On the flip side of that, FinTechs can also result in regulatory scrutiny, such as penalties or corrective action. There are definitely institutions like Blue Ridge and other institutions that have gotten into trouble for banking FinTechs, and that's because they took a wildly different approach and believed that if the FinTech was doing a lot of the operations from a BSA, AML, and other varying regulatory perspectives, that they would be covered. And that would, in that, even in their contract, they had the liability laid out on to the FinTech. At the end of the day, that FinTech was using that bank's charter, and they weren't adhering to all the regulatory expectations and requirements that are set for them. And so essentially, because they were just simply using that institution's charter, then that institution is ultimately responsible for that FinTech's activity, and they were the ones that got in trouble, not necessarily the FinTech. So there's definitely some regulatory scrutiny that can be involved in this space. I think it's really important that you guys think about that as you go into this, and that's why we're giving you the tools during this workshop to be able to think through all of the processes that you should initially when you're building out a program, and for each individual FinTech that you onboard, because they all will present different risks to your institution, and you're ultimately responsible for ensuring risk mitigation for those efforts. It can quickly and substantially alter your financial institution's risk characteristics. So, your FinTech today may look different from your FinTech even 3 months from now. They may fit your risk appetite once you begin, but as they morph and change your business model and who they bank and the products that they offer, their risk may change as well. So what we're teaching you today and walking through today is something that is living breathing documents, at least the risk assessment pieces, because you should be understanding that FinTech in their operations, not just when they onboard, but very frequently throughout, and who they are serving, so you can understand the risks that have changed at your institution and how you should be mitigating those, or requiring that FinTech to mitigate those risks. So how does a financial institution get involved with the FinTech? There are usually 3 different paths. You can be a sponsor financial institution, so that means you they're basically borrowing your charter for that. So it's very hard to get a bank or credit union charter for that matter. So it's easier to partner with an institution, so that institution is either indirectly or directly helping that FinTech move with the money movement, borrowing the charter, borrowing or being a piece of the charter. And we move on to the FinTech vendor use, so that's completely different. FinTech vendor use is you may be using a FinTech to enhance your operations, but that doesn't mean that FinTech is going out there and seeking out their own customers or their own clients. They are helping you serve your client base better, or from an operational standpoint, maybe helping you gain some operational efficiencies. It has no involvement in money movement, transfer, or compliance for the FinTech. So they're not borrowing your charter, they're just helping your institution either provide a better customer experience, or they are helping you, gain operational efficiencies. And then the other option is FinTech investor. There's a lot of institutions that maybe aren't wanting to be that FinTech charter, help them, with that piece. Maybe they don't want to be use that FinTech as a vendor, but they like their operations and they want to invest in it. RiskOut is actually a pretty good example of that. We're a regulatory technology company. We fall in the FinTech space, and a lot of our investors are financial institutions. So some of them use us and some of us don't, but they believe in the mission, so they've invested into RiskOut for that. So that's a good example for that one. So there's some really good strengths that financial institutions from a FinTech partnership side can really benefit from. You get brand name recognition, large customer base, customer base that you normally maybe wouldn't have access to. You get advanced underwriting capabilities in some aspects. You're also getting all sorts of different robust infrastructure based on, a lot of times, especially in community financial institutions, we're sometimes using older technology potentially, or maybe we don't have the staffing to be able to adapt into new technology quickly, or there's a big lift there, or we can't build our own technology. That's a benefit that the FinTech can provide to your institution, is technology that you would normally have access to very quickly. FinTechs are often nimble. They can move quicker. They have a lot of technology expertise. They have more modern IT systems, specialized solutions. So the FinTechs are really beneficial to the financial institutions from that point. And when they get together, they're sharing some benefits to each other. They're getting to utilize the charter of that institution. They are helping you provide deeper and analytical driven customer engagement. There's enhanced risk mitigation potentially, more accessible products to your own customer base, and then improved product efficiencies, which again is they're often faster, quicker, being able to build things and adapt into technology. Ryan?
All right. So when we talk about kind of how a lot of these FinTechs are structured, I think it's really important about actually kind of doing this assessment ahead of time and understanding what sort of entity you're starting to engage with. One piece I want to break out here is on the sponsor financial institution side, for whether or not the FinTech is directly engaged with your customer member base or indirectly engaged with them. And the reason for this is if it's direct or indirect, it can really affect who at your financial institution is responsible for a lot of the work. So in this example, let's say you're the financial institution and you're delivering financial services to this FinTech. If it's directly, the FinTech is going to provide a prospect to you, and you're going to provide those services directly to that prospect if at the end of the day you decide to onboard them. Now with that, your compliance staff, your operations staff, they're still doing a lot of the work. In reality, the FinTech's more operating as kind of a, almost like a headhunter. They're providing you these different accounts. Versus in the alternative, if you're doing this indirectly, you're providing the services to the FinTech, and then the FinTech is taking your services and deciding whether or not they're going to offer those to different customers or members. So in the indirect side of things, it's a lot more trust being placed onto the FinTech because you don't have that same level of insight prior to the service offering. Now, that makes it even more important when we think about the types of reporting we want, because that reporting is going to differ incredibly. In the one scenario where I'm directly providing those services at the financial institution, I have an idea of who's getting my services, what the size of those portfolios are, that sort of thing, and the composition of that. On the other side, if I'm going through the indirect, I don't know that as well unless the FinTech is actually providing that information to me. So what sort of reports do I need to request from the FinTech so that I have a good idea and understanding of what services are being provided to who? The size of those portfolios I'll have a good idea about, but the risk characteristics I need to understand better. So I need reporting to show me those risk characteristics. At the end of the day, the consumer is still receiving these services. It's just a matter of the back end that determines how you understand the risk, and so you know what's actually happening. Now, one of the other pieces to think about here is when we're thinking about actually selecting the fintech in the first place, whether or not we want to do business with them. There's a lot of decision making that goes into the types of fintechs we're willing to work with. What regions are they working in? What kind of services are they offering? Is there some strategic objective that we have as a financial institution that we're trying to accomplish? And if so, are the products and capabilities offered by that fintech actually solving for that? And if so, or if not, why not? Maybe it's a conversation I have with a potential fintech about slightly expanding or changing what they're doing to meet some of the things we're trying to achieve. In terms of risk tolerance, if we have, say, a really high liquidity profile and we have a lot of offering that we can give in that aspect, great. I think that's something that's a good thing and we can offer that. But at the end of the day, we also need to say, what's our limit and where do we have to stop? Because one of the most important conversations to have with a fintech in the beginning is, this is the size we're going to, and then it's going to end right there. Because I've heard a lot of examples where fintechs get into relationships with financial institutions and the fintech's like, yeah, we're ready to give you 2,000 customers. And the financial institution's like, I was thinking like 10 or 20. And so if you're not having that conversation at the beginning and making sure that you're aligned with the fintech on these risk tolerance conversations, you can get into trouble, not only from overgrowing that portfolio, but also kind of hampering the ability of the fintech to grow when they had a different expectation. And the last piece on that one, the business development, how long are you willing to actually be in this relationship without seeing results? What timeline do you expect to see results? And if things don't go the way you want them to go, what are your plans to either try and push it in the right direction or evaluate whether or not it's time to exit that relationship?
Yeah, I think some good points in there, Ryan, too, about setting those expectations with your fintech or who you're partnering with to find you a fintech is how your roadmap looks. What does their roadmap look like? Because most companies aren't fine with just, 10, 20 customers, right? Necessarily. Most of them have other things planned so that their customer acquisition can grow. You've got to ensure that you have the right people and the right tools and the right capacity to be able to handle that. And we hear that more oftentimes than not for the institutions that we work with that launched a fintech, didn't really quite think through it. And then they're in this mess now. And it's all about, okay, well, what do I do to clean this up? What do I need to do to mitigate some of these risks, and can I even do it, or are we just going to have to shut this down? And when you're talking at a smaller community financial institution, it's often the latter, unfortunately. And there's a lot of work that goes into if you're setting up a fintech relationship in a vertical properly. That's a lot of time and money wasted for not understanding your business partnership with that fintech appropriately and setting those parameters, because it can quickly grow out of control. So it's all about knowing who your prospect is and understanding their roadmap long term in order to listen to and understand that if it's going to really fit you, not just today, but in a year from now.
Yeah, and it's funny, it's actually going to tie right into this piece. A lot of times we'll hear the conversation that a financial institution is having with the fintech where the FI asks, hey, what do you guys do for compliance? What kind of reporting do you have? And the fintech typically just comes back and says, well, what do you want it to be? And so having that collaborative discussion is going to be really important, because at the end of the day, the financial institution is the one that has more of an understanding of the regulations and the regulatory requirements. And if you aren't working closely with that fintech to set that stuff up in the beginning, then you're not going to get the information you need, or you're potentially going to grow kind of out of control and not with what you expected.
Yeah. Yeah, absolutely. And, a cautionary tale from an institution that I worked with was they partnered with a fintech that offered home equity loans, and they offered home equity loans all over the United States, which was fine because that liability was not on that bank's portfolio. They would divide out, they had multiple institutions that they would divvy out the HELOC wealth to. And then once it entered into a certain dollar amount, they would sell that HELOC bucket to a group of investors, and then it would be off that institution's books. The issue was that was great because from a methodology standpoint, the institution was like, sure, that's fine, that works. We have minimal liability here from what's on our books from a lending perspective, but what they didn't take into account was the nationwide lending and how it affected their CRA. So they ended up getting in CRA trouble, and it just was this huge to do, because that was one piece of the puzzle they didn't think about when they were onboarding. And that was several years ago, before everybody was getting more and more educated on fintechs like you are today. But that's how deep you have to drive based on the type of relationship that you are wanting to potentially entertain to onboard.
Yep. I need you to go back one, Kristen, if you don't mind. Thank you. So when we're looking at the financial institution itself, typically you have full visibility into what's happening at your institution, right? In your internal departments, quality control and audit are going in there, reporting is coming out of that, risk, compliance, the board, the management teams, they can see that entire process holistically. You're involved in that process, and it's intimately part of just the entire ecosystem. You know that ecosystem. Now, alternatively, when we switch from a financial institution into a fintech, which is the next slide, there's a wall, right? And not the Chinese wall, not the one where some people just broke that with a excavator, I believe, over the past couple of weeks, which is a wild story. But no, this wall is fully functioning without a hole in it. And you're not, as the risk and compliance department, going to be able to see what's actually happening in the fintech. And so while many of those processes might still be occurring, you're not going to see what that actually is unless you're asking for the correct information. And so that's where this kind of coordination with the fintech becomes very important on how we determine what is getting piped out of the fintech to your financial institution, so you can take a look at it. Now, on the next slide, we'll show a little bit about how that actually looks. And so it's a matter of taking a lot of the information that you see in third-party risk management guidance that was originally published in 2013, but and this is from the OCC, and there's more guidance that was published in 2021, that's Bulletin 2021-40. Now, with the two of those, there's a lot of information saying like service level agreements, key performance indicators, different types of things that you want to be looking at from a risk management perspective. And that would be for any third party and a fintech, but how do you get that information to you where you can actually status it, review it, analyze it, and make sure it looks the way you want it to look? And so setting up what that information is with the fintech while you're starting up that relationship and saying, maybe on a monthly basis, I want XYZ portfolio characteristics on new originations. I want the following portfolio characteristics on the existing portfolio, and I want any results, findings from audits, or say second line of defense type reporting that was happening at the fintech. Having that actually sent over to you, and then on a periodic basis reviewing that as the financial institution saying, yes, these all align with what we expect to be happening with the general risk tolerances that we typically accept. And also it's part of your process for understanding risk, right? It's not just I'm evaluating the risk, but you're evaluating the risk the same way you would for something that was happening internally. Because just because the fintech is an external party doesn't mean it doesn't have the same responsibilities and risks as if you had developed it internally. And that's really what auditors and regulators are talking about when they say we just want you to be able to understand and tell us the risk as if you had built this out yourself. And the requirement isn't that you built it out yourself, it's just that you know what's going on and you have enough information to make decisions, to make changes, to really actively manage this program. And so that can kind of inform how frequently you're requesting this information, how frequently you're reviewing it. Now, some of the other pieces you're probably going to want to take a look at while you're going through this review process are going to be items that just run in the background. So background checks, OFAC scans, negative news, anything like that, just actually on the fintech itself. And then more than likely, you want that sort of stuff occurring on the people that are gaining a service from the fintech, but that could be completed by you, that completed by fintech. It depends how you've structured that relationship in the first place.
All right, let's talk about enhanced due diligence for fintechs. We keep bringing it up over and over again, but understanding what that fintech does today and then what the roadmap is extremely important. what's the risks to you and how do you measure and monitor those risks? So a lot of the way you can measure and monitor is on that last slide that Ryan spoke about. But that has to be a detailed understanding and agreement of that and setting these expectations with that FinTech. Not just at onboarding, but resetting those expectations on some type of set cadence, because a lot of times both parties can end up too comfortable in a relationship and there's complacency that can happen. And they don't necessarily inform you like you're expecting to be informed, but you don't know that because they're giving you the information you typically request and everything's checking out month over month or quarter over quarter when you're reviewing them. And if you don't have a way to assess that FinTech on some type of recurring set cadence, you're not going to know that if their risks have changed since onboarding. You also need to understand the sources and use of the funds. You need to understand what their business operations is. If it's deposit relationships, if it's lending, if it's merchant service, if it's this, that, or the other. This requiring them to provide you with a flow of funds and how they source those uses and how they identify the customers, the originator and the beneficiary, and check all of those. That will help you better understand what questions to ask and what needs to be monitored. So if they are the party that's going to be the one responsible for monitoring, you guys have come to that agreement. That way you can check to say, are they holistically looking at the risks from their monitoring perspective the same way I would expect our institution to do it, because that expectation should match up between the FinTech and the institution, and if not more robust on the FinTech if they are offering solutions that your institution does not typically do today. And then right-sized compliance, we talk about that a lot in our space. Building a reasonable and achievable program. It's not necessarily your job to police every single transaction that's occurring there, but you do need to be specific on what you're asking for when you do want to review. Over-compliance strains creates unnecessary extra work and creates a strain in that relationship. And while you may think you have a great relationship with that FinTech, if they get offered a better situation at another institution that they need to provide them with less cumbersome information on whatever cadence, you may have set up this whole vertical for that FinTech to go bank somewhere else. Those are things you need to think about. We talk about this a lot when we talk about cannabis. It's not your job to be the DEA, right? Just the same thing with FinTech. It's, find that right balance of a reasonable and achievable program where you guys can feel comfortable that the risk mitigation efforts are truly being adhered to as agreed upon between both parties and that they're evolving over time as products and services change at that FinTech. You need to also monitor industry trends and market events. This is true in all of BSA AML compliance. Understanding industry trends and market events is going to let you know, hey, is my FinTech are the products and services that they offering in the customer base you're serving part of some industry trend or market event that may cause additional concern? That is all about that ongoing relationship that you have with them. Because if you're think about all the institutions that had FinTechs that offered some type of crypto-based type of relationship, that when the whole crypto crisis happened, I guess that's probably almost a year or around a year or so ago, that brought different concerns, right? That brought concerns for a lot of people. And did they kind of wash over and brush stuff off? And are they vulnerable for any type of regulatory issues or any type of capital issues, so on and so forth? As you understand those trends and you keep abreast of them, and you really, really know your customer being, or your member being your FinTech, then you're going to know the right questions to ask, and in order to know if they are addressing those potential issues within their own business model. And really leveraging regulatory agencies to validate your own due diligence. If they are licensed, a regulator is likely examining your customer or your member on a regular cadence and are looking at the same thing you are. If that's the case, this reduces regulatory risks in your FinTech portfolio because they have a governing body over them that is ensuring that they are doing what they say they're doing. That doesn't happen all the time with FinTechs. I would say most of the institutions that we work with, that FinTech does not have a governing body, so that does take more due diligence than maybe if they did have a regulatory agency. But at the same time, there's enhanced due diligence involved, regardless if they are or not. It just may look slightly different.
Yeah, with that request for regulatory information for any technology service provider, which would be a term designated by the OCC or other federal bodies, they are regulated by the OCC. And so you can request that report. Now, the caveat is you can't request that exam report until after you've already engaged with them in the service, which seems kind of backwards, but that's kind of the world we live in privacy of information. But just a good thing to know. So say, for example, you do have some of these larger technology service providers, even if it's not FinTech, you can request the report of exam for that entity from the previous period and just see, hey, where are there vulnerabilities that our financial institution might be exposed to. I think that's just good information in general.
Absolutely. You want to take this one, Ryan?
I would love to. Okay. So a lot of what we also talk about here is kind of cost benefit. And so what is the cost of getting into these relationships? And so there's probably a cost for you periodically gathering information. So how are you going to do that? Are you going to have a tickler system that's at the institution? Maybe it's an Excel sheet. Maybe you've set up some sort of calendar alert in Outlook or Gmail, and you're sending out a Word doc or a PDF or something like that every however long and trying to gather information. And then is it hard to implement that process? Is it hard to maintain that process? I know if you're doing that manually, it's easy to miss things. How are you actually tracking the audit log for that so you can show an examiner or an auditor, yep, I did this, it was all on time. Here's my attempts to reach out that didn't work. Here are the attempts that reach out that did work. Kind of all of that sort of information. Another piece would be on the reputational side. So are you entering into a new service, a new industry, a new vertical, something like that, that could affect some of your existing customer member base? Think about, for example, if you were starting to go into, say, like a FinTech that serves primarily firearms dealers, and maybe your board of directors is entirely staffed by people that regularly fight the NRA. That may cause some just contention within your institution. It probably will also cause contention in your customer or member base if a lot of them are aligned with your board. Kind of a weird example, but I think you get the idea I'm talking about, where it should align with the general persona that your financial institution exudes. And it could also affect different business lines that are already in place. So if you had, for example, that firearm portfolio, and then you also are the banking relationship for, say, like a community or a anti-firearm group, they're probably not going to want to stay at your institution. There are a lot of different examples for that. Community organizations in a variety of different industries and types of services. And then typically there's a broader strategic partnership or strategic rationale for some of these relationships. Kristen, would you mind going back one slide? Thanks. Typically there's a broader strategic rationale for the partnerships. And so it might not be a solely A to B cost measurement. Maybe this is something that runs slightly negative every year, but the idea is that you wanted to offer some service to your existing customer member base so you stay relevant or competitive against other financial institutions in your area. So trying to wrap in all of the strategic benefits that might be in place from this relationship, not just the dollar signs, is really important, because sometimes there are non-tangible benefits to these relationships. And then lastly, how does the partnership enable growth, maybe in other areas of the institution? It could be you're allowing a different type of individual to come into your institution because of this. Maybe that opens up different areas for lending, payments, anything like that. And if that's the case, you want to try to assess how much return does that actually offer for me? And does that move the needle up or down in maintaining, exiting, or even starting this relationship? And so when we talk just in general about managing these FinTechs, if you're taking anything out of the prior however many slides we were just talking about, is performing detailed onboarding and reference checking in the beginning, making sure that whatever kind of party that you're starting to engage with understands how financial institutions work. And if they are new to this space, really make sure you're working with them that they get it right. That includes collaborating on the policy and the procedures, because that needs to be right. You don't want to be one of the regulatory actions that end up coming up down the road. Consistently monitoring and reviewing the information that fintech is producing about their portfolio, about the new types of customers or members they might be serving, and assuring those all align with the risk tolerance and procedures, practices that are accepted at your financial institution. And lastly, documenting this really well for your auditors, examiners, even for yourself. If it can't be documented well for someone else, how have you been reviewing the information? And the answer is you're probably not reviewing it that well. So that documentation really ends up being an internal tool as much as it is as kind of a, look, I did what I was supposed to for somebody else. Things you shouldn't stop doing is, Kristen mentioned this, where people get comfortable when they keep working with each other for a long time. Don't stop doing the due diligence that you've had in place just because you're starting to get that comfort level. It's really important to maintain that level of diligence. And lastly, don't make assumptions about reputation, financial viability, operational or regulatory know-how. And really this is more on the kind of like starting off point, but also in your annual reviews or whatever the frequency is for checking up on this sort of stuff. But what kind of staff does that fintech have on staff that actually understands the regulations, that understands the banking world? How much funding do they have? So for example, if you're starting to get into a relationship with a fintech, you expect them to be there forever, but their runway of funding is maybe the next 6 months and you don't see any in the future. That's kind of a dangerous place to put yourself, because you're going to put a lot of work into this and then it might just disappear. And then lastly, on reputation, you really want to be talking to different financial institutions or different individuals that have been served by this financial technology company, and making sure that the experience they've had is the experience that you want to be reflected on your institution.
All right, now the juicy stuff, right? We're going to walk through the FinTech policy, the risk assessment, and the ROI calculator. The policy, our philosophy with policies is you don't want to over design a policy because it will always pin yourself in a corner. So we address the appropriate things within a policy that should be there. And the majority of your work is going to go into your risk assessment, and after that, your procedures. So we'll spend a little bit of time on the policy at a high level. The risk assessment is extremely detailed. We're not going to go into every single section in detail, but we are going to hit the hot spots, and if there are things that you want to follow up on. And then Ryan will talk through the ROI calculator here. So bear with me while I shift screens here. Oop, oop, oop. You know what we're going to do? Stop sharing for a second. Let you feel the air, Ryan.
I muted myself. Well, let's see. While Kristen takes a look at that, I'm going to try and think of some other, I guess, items that I saw when I was regulating financial institutions, and some of the areas where a lot of this went well and a lot of it may have gone off the rails a little bit. I know one of the things that we saw that was really interesting that was typically leveraged by community institutions was just kind of taking these projects and really getting input from a lot of different areas of financial institution. And so when you start to plan out whether or not you're engaging with this fintech, having a team that's almost like deposit operations, compliance, loan operations, loan compliance, the senior management team, risk, everyone, and getting them all together and having everyone's thoughts on where the risks are, and having that entire group make the pitch to the board. That way you're really encompassing all the different factors that are touching the fintech, and you're much less likely to miss something that's going to come up down the road where it's all of a sudden your CFO says, well, hey, this could have done something for me, and if we had done that during the actual rollout of it, it would have saved us a lot of time, or this is critically an issue and we can't do it because of XYZ. So getting those multiple viewpoints, I thought, was a really good practice by institutions I saw employ it.
Yeah, absolutely. And again, this policy that we're walking through does say BSA AML all over it, but it has morphed into being a little bit more encompassing than outside of BSA. Our main point was that by highlighting a lot of the BSA points in here, we're thinking about the risks where that get the most scrutiny normally in the fintech space that people just kind of brush off. And so we want to make sure that we're covering that BSA AML. And I say brush off because, you know, they do put agreements and contracts that say that, hey, FinTech is responsible for many of the things that we're going to go over, and then they don't have that testing ability, that FinTech doesn't have the right staffing or the know-how to do it, and then they're missing things that you're ultimately responsible for. So we do focus a lot on the BSA AML in here, but you can take this template and build upon it. That's what the purpose of it is for. We want to always lay out what our introduction is. We want to say that the why behind what we're doing. The objectives of this main policy are to detect and deter illicit activity, make sure that the FI complies with all BSA laws. We're going to talk about the risk assessment piece, but we want to call it out in the policy that the risk assessment is going to occur. And it's going to be specific to FinTech. There are chances that you could take the BSA risk assessment or the FinTech risk assessment rather that we're going through, and then add it to your existing risk assessment process. Maybe you marry some of the sections in there. I don't necessarily recommend that. I think a FinTech is such a delicate space to be banking that you need your own designated risk assessment, your designated policy. It should not live in any other areas of meaning like your overall BSA AML risk assessment, because there are so many specific risks that you need to think of. You should also lay out in this policy how often and what the cadence is for that FinTech risk assessment being completed. Not necessarily just being completed, but when is it going to be reported upon the conclusion of that risk assessment, and who are the parties that are going to be privy and care about what that FinTech risk assessment process is going to be in regards to the results, sharing the results. The risk assessment really should be a living, breathing document if you want the most bang for your buck out of it. But there should be some type of set cadence where key stakeholders are getting to know the conclusion of that, and then any action items that you are recommending should occur in order to help continue to mitigate the risks at your institution. The customer identification program, the CIP policy you probably already have at your institution, can be built upon to include what you're going to do to identify not just the FinTech, but how are you ensuring that the FinTech knows their customers as well, because at the end of the day, they ultimately are your customers. So ensuring that you have thought through that CIP piece is a critical path that your auditors and your regulators are going to want to know you've thought through.
And if you think about when we talked about the direct versus indirect FinTech relationships in the beginning, sometimes this process might live at the financial institution, sometimes it might live at the FinTech, and there's a validation aspect that's conducted by the FI, but that's the type of stuff that you're documenting in this policy.
Yeah, absolutely. And if it is a responsibility of that, and we'll talk about this a little bit more in the risk assessment, if it is a responsibility of that FinTech to be collecting that information, it's okay, it's reasonable for you to say, I'm going to test 5-10% based on the size of the portfolio, to ensure on some type of set cadence to ensure that they are really doing what they say they're doing. And that's not just in regards to CIP, that's everything, but CIP in particular, there needs to be an understanding of what they're collecting, how often, and how are they validating that information if that's necessary. The customer due diligence and enhanced due diligence is something you'll want to lay out, may differ from FinTech to FinTech. You want to just list in this policy that you thought through it and it's detailed in your procedures, because it may look different for FinTech A than it does for FinTech B, but in here you're going to lay out a minimum of the criteria that you do expect and where those procedures come into play. Suspicious activity reporting can be a little bit of a tricky thing for FinTechs and the bank to figure out and feel comfortable with. I will say that a lot of times on the suspicious activity reporting side, it ultimately, most fintechs end up being the ones that are responsible for producing that SAR, or at least escalating potential activity to the BSA appropriate personnel to decision whether a SAR should not be filed. But this also boils down to they have to the right staffing on hand. If they are the ones that are responsible for the SAR reporting, are the folks that are working at that fintech able to detect illicit activity, and do they even know the SAR filing requirements and processes? I can't tell you how many institutions we've worked with in the past that have put the faith, thought they were going to put the faith into the fintech to do it, and quickly found out that they don't have the appropriate staffing that is well trained enough to know what those requirements are for SAR filing. Especially if you're dealing with fintechs that have a large customer base themselves, the more they grow, if their technology isn't robust enough to help them detect and deter illicit activity, then you're running into, as they grow, it's only going to get worse. How do you mitigate those risks? So you, in here, this area, you're going to define who the SAR, who's responsible for the SAR filing, and that you guys ultimately know that you are responsible for ensuring that SAR reporting is adhered to, whether or not it falls on you or falls on the institution to file that SAR. Training is so essential in this space. We always talk about at Risk Out, staying abreast of industry trends as well. Just having your basic BSA AML knowledge is great, but understanding the intricacies of what's happening at a broader national level with fintechs, especially the fintechs you're serving, but even boiling it down to what's happening at in the space that their customer base, the customer base that they're serving, you know, based on the products and services, knowing that, boiling that down and understanding that on a reoccurring basis, and then helping them stay up to date on regulatory requirements and anything that may be changing is important. So you want to define here that you are going to actually support your staffing when it comes to training, and that you're going to do that at least on an annual basis, that they get industry specific training on this. And it doesn't just have to be your BSA AML staff. It needs to be really any department that is involved with managing that fintech relationship. Audit and review, we've talked a lot about already. That's important from the prove it standpoint, for lack of a better term. When you want to prove to your auditor and regulators that you are ensuring that this fintech is operating safe and sound as you agreed upon, you're going to have to show that the proof is in the pudding, right? And you're going to have to let them know. So you're going to detail here what that process is going to look like. Now, it may look not necessarily, you don't want to make this, never make a policy or procedural document, but you want to clearly define that you know your responsibilities here, and that your process for ensuring that the audit and review happens are detailed for each fintech in a separate document. You know, record keeping requirements are at least 5 years for BSA AML after an account is closed. So you'll want to just keep that part light, but state that you know those requirements. Policy review and updates. How frequently is this policy going to be updated, and what are the requirements for getting it updated? Who can approve it? Usually the board of directors for large changes anyway. Consequences of non-compliance. So what's your exit strategy there? What is something that you want to, if there's issues between your own employees not adhering to whatever it is that you agreed upon, is there going to be disciplinary action involved in that? It's really up to you how detailed you want to get in this area, but it really should also include potentially exit strategies for fintechs that are non-compliant as well. And then policy exceptions. Most institutions end up having a committee that are set up for BSA or for the fintech space, so there may be an approval process that goes through the committee, and then any issues or reoccurring updates are given to that committee for review. You need to detail that process, and also when is the board of directors involved in those conversations. And then clearly always defining what your BSA AML compliance officer is responsible for in regards to this is always important. We want to especially distinguish that they are the main person that is responsible for helping ensure that that audit and review process works, that open line of communication exists, and that suspicious activity is being reported accordingly. And so that's at a high level the policy. Again, we don't believe in pinning yourself in a corner and over designing a policy. For every one of these policies, or this policy and this risk assessment, we do have some that are completed, and we are happy to provide you that redacted versions of them too. So it's kind of a little cheat sheet for you guys. This is a 1.0 of a cheat sheet, but if you want to see what other institutions are doing, we've got permission from them to share the redacted versions of those so that you can have a starting point. Anything to add on the policy?
No, I think you covered it really well. This policy, to Kristen's point, shouldn't be overly prescriptive, because yes, there's going to be ways that you want to manage something, but you don't want to paint yourself into a corner. You don't want to be stuck with a process that might be more than really needs to get done, or is just really excessive, because when an auditor or regulator does come in and sees that, they'll be holding you to those standards. So cover the things that you should be covering, and then if you decide you kind of want to test out some different methodologies, get more detailed, less detailed, test those out before you really make sure, before you add them to that policy permanently, and make that kind of like inscripted in the, I'll say policy. I'm trying to make an analogy that's way too excessive.
Yeah, and I think, but Ryan makes a good point in saying that whatever you've written in your policy, you better be doing, right? So you don't want to overcomplicate it, and so you're doing all these things that are not achievable. Your policy is there to be your guideline. Your procedures are there to tell an employee step by step what you do. And so the more, if you have to change a procedure, you certainly don't want to have to go to the board to update your policy just because your procedures are in your policy. Let me make this a little bit bigger here for you guys. It's really big, maybe too big. All right. This risk assessment is a little bit of a beast. And if you are like me, if risk assessments are not your favorite thing in the whole world, but there is another better document, if you have a robust document that will tell a better story than a risk assessment. That's plain and simple. So while they may be painful in nature to go through, they're not a check the box activity. They're a time for a real reflective moment so that you can understand that the whole point in doing a risk assessment is you can understand the health of your institution today and what needs to be covered for you to maintain a risk level that you guys have all agreed upon. And that falls in within regulatory guidelines. This risk assessment covers outside of BSA AML. And that's purposeful because there are many other things to think through. But at the end of the day, you have to, when you go into a risk assessment, say, this is almost my defense mechanism for making my points of what I need to ensure that the bank has a successful FinTech vertical, as opposed to trying to piecemeal a program together as you go along, because you're understanding things that you're learning things as you go along always. But if you go in there thinking you can do it based on the tech stack you have today, that may not really be true, because based on the FinTech, it may present different risks. So you want to be methodical as you go through this, because this is going to be the document that you summarize for key executives to help you get the tools or the staffing or both that you need in order for you to successfully run this program. This document, when done well and thought through, on the surface, it's 15 pages right here. The last couple I've done, end up being, with all the text, 60+ pages. And I'm not trying to scare anybody, but that's just how thorough you end up thinking through these things. It's also important to know that when you're going into this risk assessment, most guys that are starting on a brand new vertical don't necessarily know. They know what areas that they would serve, so deposit relationships, maybe lending relationships, maybe other types of relationships, but they don't have a fintech yet that they are entertaining. This risk assessment can be used two ways. It can be for your brand new verticals that you don't have a fintech in queue yet, but you're thinking through what you might need. And then this one really needs to be completed for each fintech that you, before you're onboarding, because it's also tailored to help you think through each individual situation. So there should almost be a fintech risk assessment for each individual fintech that you are entertaining. This particular risk rating methodology within this risk assessment is simplistic a little bit in nature. Low, medium, and high risk are what we assign them. Anything, we're also thinking through, give you a visual here. Inherent risk, the risks that naturally exist when you are getting into a certain vertical. What your institution already has in place, that's your risk mitigation that already exists today. And then from there, you're going to be able to determine what your residual risk is. Your residual risk is anything that's left over that your existing processes today won't cover. Anything with a residual risk of moderate or high requires an explanation on this column in the risk mitigation plan. That's purposeful in nature because that's going to help you really think through and document what tools you might need, what people you might need, or what processes might already have to change with the existing tech stack or staffing that you already have today. Risk mitigation plans can sometimes feel pie in the sky, but you might as well lay out exactly what it is you think that you might need and get ahead of that. Because what you don't want to do is make some of the same mistakes I've made in my career where you just want to make something work because you want to be a yes if, not a no department, and you think you can do it with your current tech stack today because maybe you think you can because you don't know any better. But I'm telling you today, you don't want to go and launch a program and then go later ask or set triggers for staffing or additional technology considerations, because they're going to come back and say, well, you've been doing it manually by yourself already. Why should we invest in a tool today? So it's better to lay those expectations from the very beginning. Anything to add, Ryan, before we deep dive in here? All right. I will try not to make anybody sleep here, so I'm going to hit the high parts here. There are different risk assessment components that we consider in here. So if I scroll back up to the top, we're looking at these 6 areas of consideration for the fintech. So we're looking at the fintech's customer base, product line and services they offer, any geographical considerations, transactional risk involved in that, regulatory compliance, and the fintech business evaluation. Don't sell this one short on yourselves. We'll tell you why in here shortly, but that is a very critical path for knowing how viable they are long term. Some of these areas may feel kind of repetitive between the different segments within these components we're looking at. That's purposeful because there's different viewpoints of those risks that are involved from different areas. So you may get in here and say, some of this looks the same between components. That's, that is purposeful in nature. So we're going to look at the fintech customer base to start with. We're going to look at customer segments. That means who are they targeting to serve? What markets, demographics, geographical locations, industry sectors, any new unique risks. So we do have some institutions that do partner with FinTechs to run things that are not necessarily inside their scope that they're willing to admit to, such as cannabis. We have different institutions we work with that partner with FinTechs who are like running cannabis wallet companies, so they can assist with the payment processes. That institution may not want to openly bank cannabis, but that is still something they have to think through, because those customers are ultimately their customers, right? And that cannabis sector is something you would have to know that they are serving, because if you haven't actively thought through a cannabis banking program, guess what? Now you're going to have to build a cannabis banking program. So those are the things like you have to get down to that level. And while they say today they might not want to go serve cannabis or other higher risk industries such as MSPs, whatever, that's part of understanding their roadmap long term, because while today they may say that they're not doing it, but doesn't mean tomorrow that they aren't. So that's why it's so important to dig so deep into here. You need to also understand if your risk appetite aligns with whoever the customer base that they're serving. So again, we use the cannabis one as an example. If that's not in your risk appetite, if it's kind of what Ryan said earlier in here is, if you have a boardroom full of folks that are morally opposed to cannabis, maybe that's not a right risk appetite alignment if you're serving a wallet company from that perspective. Reputation and branding, that goes back to, does that FinTech's branding align with what would be acceptable at your institution? What's their reputation? Are there any negative events that have happened that would, if the public found out that you were the one that was allowing that FinTech to operate the way it was, is that going to present potential reputational risk to you that you may have customers or members leave because of? And then growth potential. We talked about a lot of this in the beginning, is the FinTech's target base and how quickly they want to grow. Not only how quickly they want to grow, because we don't want to scare you as in saying they're going to grow so fast you can't keep up, but you also may have an expectation that they are going to grow and they end up with 10 or 12 customers. And so really understanding how their marketing plan is and all of that is going to let you know, so that you aren't beefing up staff or something that ends up being an teeny tiny little FinTech that you've spent, a decent amount of time and resources building for something that just isn't viable. Anything to add for that section, Ryan?
No, I think you nailed it. We did get one question, which was whether or not you had said that each of these FinTech risk assessments are for individual FinTechs or for the entire kind of FinTech section of a financial institution.
So it can be used two ways. It can be used, one, as if you are just starting up a new FinTech vertical and you want to kind of evaluate your processes as they are today, and based on what FinTechs you think you might serve, you can use this document to help you think through that. We use this document a lot with different institutions to help them think through, okay, almost like what's the worst that could happen if we banked a FinTech that is at our very, very inch of our risk tolerance. We're going to be thinking through what's the worst that could happen and complete this risk assessment with that in mind. But then for every risk assessment, or for every new FinTech rather that you get in, this is a document that you would use to evaluate those individual FinTechs as well. So it's designed to serve both ways.
And I would echo that from Kristen's point, that when you have these different FinTechs where they can serve such dramatically different segments and offer such dramatically different services, one risk assessment for kind of the entire FinTech portion of the financial institution might not accurately reflect risks that then come from different FinTechs you engage with. So really trying to identify the specific niches and specific risks at each FinTech is going to be important, and this is a great way to do that.
Yeah, absolutely. The FinTech product lines and services, this area is going to help you think through deposit, lending, payment risks. So there's some institutions that we work with that say, I will absolutely not lend. I will absolutely not payment services, just deposit based. That's great. Whatever your risk appetite is to begin with, but that's also part of assessing that FinTech's goals is if they're only a deposit relationship, will they potentially be lending? So I don't advise that you ever say it's out of scope on here. You're not going to address it all. Just say just go ahead and address and say, if we were to do a FinTech, because you may have a FinTech come that is just too good to turn down and you're going to change your mind on certain things, go ahead and think through what it would take for your institution to do these certain areas, deposit, lending, and payments. And that needs to also include thinking through what's potentially your exit strategy and contingency planning if A, the FinTech fails, or B, you want to exit the FinTech space altogether. How would that affect your, maybe your deposit to loan ratio, your capital, all of that kind of stuff through there. This also includes considerations too around fraud prevention, regulatory compliance related to deposits, so on and so forth. We'll talk about all that a little bit more in detail. Customer onboarding and KYC, we talked about that during the slide deck area of this portion, but it's really dialing into how is that FinTech going to collect CIP information and validate that they're doing business with a legitimate individual, and that you have check all the CIP boxes is at least the minimum of what you're required to check. And that way, you're going to test that if they're the ones who are ultimately responsible for it, because they 99.9% are. What's your process going to be for ensuring and auditing that they are doing what they say they're doing in that regards? Data privacy and security risk is huge in this space. Understand about their data protection, their cybersecurity, how are they safeguarding your customer information, their customer information, and what's their compliance with data and privacy regulations? Have they even thought through that? This might be an area if you're just launching a FinTech that you don't know a lot about, you don't understand, but there are good things to think through in the very beginning about what you would do to assess that. Is this going to be a part of the vendor management process where all of this part is assessed by a certain department at your institution? Or do you need to create a different policy or a different responsible individual who is specifically looking at this? Or do you want to involve a law firm? That's fine too. So there's different ways to mitigate that, but it's hyper critical that you think through it, because what you don't want is a data breach of essentially your customer information and having to address that. Anything to add for those sections, Rand?
I'd add on the data piece. So there's not only the potential illicit access to that information that would be very negative, but also just losing the information altogether. So make sure your backup processes or whatever you're planning on doing from a backup perspective has key information from the FinTech in case they were to, for some reason, lose certain information. That's a very real risk that I have seen come to fruition, and no one is happy when it does.
Right. All right, we'll move on to geographical considerations. There's definitely different geographical risks. We talk a lot in BSA AML about HITA and HIFCA risks, but we're also talking about OFAC sanctioned countries. A lot of institutions we work with say, I'm not going to do anything international. Well, okay, that I understand that completely because the risks are different, but how are you going to test against that they are actually not involved in any international activity? How are you going to make that FinTech prove that that's not happening? There's different geographical risks in our own country, in our own, neighboring countries all around the world. So consider what countries they're involved in. Also, where is that FinTech located? There may be different rules and regulations that are involved because they are in a certain state, they're in a certain country that has different regulations over FinTechs than maybe your particular footprint serves. I've seen that happen quite a bit with our FinTechs. Even in the state of Texas has a little bit deeper laws over reporting of certain activities. And so you need to ensure that if the FinTech is serving a customer base in that area, that they understand that those rules apply to them and they need to be reporting on certain things.
Yeah, one thing to add on that, Kristen, is so for example, when we used to go in from the regulatory side and look at, say, municipal lending, municipal bonds, that sort of thing, when a financial institution was getting those from, say, like geographically distinct locations, like say I got some sort of bond from New Mexico and I'm in Massachusetts. Well, I probably don't understand the nuanced risks of New Mexico. And the more you accept things from different geographies without an understanding of maybe some of the specific risks in that geography, it just ends up being probably a portfolio that's going to have higher loss characteristics just because I don't fully understand what could be impacting some of those loss characteristics. So keeping in mind, if you are expanding to different locations, just what's going to be your process for assessing that location in general? How do I start to understand a little bit more about what happens in that state, in that region, that might affect how I issue debt or how I accept a deposit account or something like that?
Yeah, great points. When we talk about regulatory environment, we touched on that just a second ago, which is understanding the compliance requirements of those geographical locations that they serve, where they serve customers, their own customers. This includes understanding the local laws, licensing requirements, and regulatory oversight. So they may be required to be licensed beyond what you think they are for your footprint. So it's just really understanding the customer base that they serve will help you better understand those risks involved from a regulatory scrutiny standpoint. There's also issues with economic and political stability. This is, sometimes not even just involved with international countries, it can be within our own country, but understand what the customer base that they're serving and, really assess the market competition in that area. Is that FinTech saying they're going to go target a certain area that is maybe economically or politically unstable? Maybe that's oversaturated with being served to begin with. Maybe that's not a great business plan for them. Maybe not somebody you want to entertain. Also can open you up to different risks involved with money laundering or illicit activity or fraud for that perspective. If you're dealing with somewhere that has a transparency rating of really low in regards to that economic and political or AML oversight that they have in that country. That leads into financial crime risk. What is their financial crime risk there? I think just sidebar note, it's really interesting. If you look at the different reports from different countries all over the world over their AML oversight, I was watching a Formula One race and that was happening in Monaco and just was interested because there's a bazillion yachts all around Monaco and just reading their AML report about, oh, yeah, this explains why there's so much money funneled to this area. That crime doesn't necessarily happen in that country, but it is definitely funneled through that country and they have a terrible AML risk rating from an international standpoint. So you thinking through those types of risks is saying will help you better understand the risks of allowing that money to flow through your institution, essentially. The legal jurisdiction, who's the governing body over the FinTech operations and how does that implicate your data protection, consumer rights, so on and so forth. And cultural and language factors, that's huge. If they are, in specific geographical locations, even in our own country, they may speak primarily different languages. How is that FinTech going to adhere to that? How are they going to ensure that their disclosures are in a language that their customer base, their primary customer base they're trying to serve understands? Really thinking through those pieces right there. Brian, anything to add there?
Kristen had brought this up much earlier, but just the CRA implications. So keeping an eye on your in and out ratio for lending, on how many of your loans are within your assessment area for CRA and how much is outside of your assessment area for CRA. And so just looping in whoever's responsible for that at your institution to assess what the potential impact of this relationship might be. And then Kristen made a great point on just within the US, there's a lot of subpopulations of different ethnicities, backgrounds, languages, things like that. If your FinTech is going to be targeting one of those, just how is that being done, and is it appropriate for that consumer base that might be joining your institution?
Absolutely, good points. Transaction risk is a huge piece of the puzzle here. What are their transaction volumes like? Is your institution going to be able to handle it? A lot of our FinTech relationships that we work, or the institutions that are thinking through their FinTech verticals or already have it, are using a middleware, which means that they have some type of side core potentially that is allowing the transactions to run through. If you don't have that, or you have some other way, how are you really going to understand that the transactions occurring at through that FinTech partnership is really legitimate and there's no illicit activity or something that maybe you need to report through suspicious activity report? You need to understand that the transaction types and all of that are within your risk appetite, but also how are you going to detect and deter or detect and report illicit activity if you can't even see how the transactions are flowing through? Because many FinTech relationships are set up with FBO type accounts. So meaning that, okay, all of the transactions occur over here, maybe in this middleware or side core, and then they funnel into this FBO account. So really at your institution, you're only seeing one transaction in per day or one transaction out, the inflow and the outflow. And that you don't know all the underlying stuff that happened and whether it was legitimate or not. So that's something you have to really think through of how you're going to understand that from a transactional risk standpoint. Some institutions do make every customer have an individual account. They don't decide to go with the middle core or the side core. They make every one of the FinTech customers open an account so that the activity is running through that particular account. Is that scalable or sustainable? I don't really, it really depends on the type of FinTech relationship, but they do that when they don't have a way to have those transactions run it through something in a manner that allows them to be able to detect illicit activity. The transaction complexity touches on, what type of products and services are they offering and how convoluted can that transaction complexity become, and can your institution handle that transaction complexity? The same, I touched a lot already on transaction monitoring a second ago, but really I can't stress enough how this just falls through the cracks all the time. If most of the relationships that we have seen built typically will include some type of that FinTech partnering with a third party for transaction monitoring. If that's the case, that's great, but you need transparency in there. You need to be able to go in and audit and look through to ensure that whoever is there mitigating or looking through and using that transaction monitoring system, that you feel comfortable with their decisioning of alerts that come through and the alert parameters that they have set so that they know how to detect illicit activity. And then same thing with transactional relationships. Who is the originator? Who's the beneficiary? Who's the counterparties? Understanding that flow of funds we talked about earlier will help you understand where you need to put risk mitigation efforts in place. Anything to add, Ryan? All right.
No, looks good. I think, okay, I like one thing. When it comes to the audit piece of just taking a look at what the FinTech is doing on the transaction monitoring side, just because they're generating alerts doesn't mean they're reviewing them and understanding if it's risky or not. And it doesn't mean that they're actually statusing them appropriately. So just because they have that monitoring software in place doesn't mean that they're using it correctly. And that's really kind of the key that you're looking at in that audit, is that they're using it correctly, not that it exists.
So in the FinTech and FI regulatory compliance, this is where it can start to feel a little bit repetitive to the other points of what we talked about. Some of it does cross over paths, but it's important to think through specifically. Because when we talked about the regulatory pieces, we were talking about data security and transactional risk, but this is also dives a little deeper into what applicable regulations are specific to that FinTech's offerings, and do they check the boxes for adhering to all of those? If not, why? And how am I going to know that they're doing it long term too? That's part of your risk mitigation plan. What's their compliance obligations? This involves evaluating their policies, procedures, systems, and controls. Don't you let them just verbally tell you they're doing something. You better see it in writing, because in our world, if it's not written, if it's not documented, it didn't happen, and then you better go back and test that they are doing what they say they're doing, because they're just as your regulators are going to walk in and look at your policy and say your policy says you're doing this, they want to ensure you're doing that. You should do the same thing for your FinTech. Data collection and monitoring, we've talked a lot about, Ryan. I won't go into much detail of that for sake of time, but really having that transparency into the systems that they're operating off of And then having a way to request and collect information and document your audit trail is also equally as important. What's the reporting process for SAR reporting? Again, we talked about SAR reporting to begin with, but consider their knowledge, what staff they have in place to think through these pieces. Do they have regulatory oversight? Ryan spoke on that earlier. They do if they fall into certain categories, they don't for others. If you've already engaged with them and they fall into one that is regulated, request that document. That will tell you a lot more than what they're willing to tell you. If they are operating internationally, are they adhering to cross-border compliance? What's their culture of compliance at their FinTech? Or are they just to grow fast compliance later, BSA later, or are they really there to ensure their own health for the sake of maintaining that relationship with you all? Regulatory health we've touched on, and have they had any enforcement actions? Have they had any BSA AML audits? And if so, what are those results for those? If it may not be required for them to have BSA AML audits, but maybe it's something that you guys require them to do, because a third party coming in there and really dissecting what is going on at a deeper level than what you get to see every day will even provide your key stakeholders internally and your auditors and your regulators with a better story. Does the financial institutions, this BSA, this also accounts for both the financial piece too. The financial institution, if you're under an enforcement action, perhaps first prior to engaging in this space. Same thing with BSA AML audit results. If you have a bad rating there's probably some stuff you need to address before getting in the FinTech space. You got to make sure your board's bought into this. This is a huge undertaking for your institution. They're going to have to invest in people, resources, potentially. They're going to have to stay engaged, make sure that they're on board. Expertise in staffing. Do you have the right staffing in place to run this program? You should have a designated SME. Who is that? What's your contingency planning for that, or succession planning for that process too? Some people want to win the lottery and never work again. What's your plan for that if that happens to be your SME? And usually technology is a good place to start, because if you have the right technology in place, that means you have a program in place that can be picked up by any employee, and they can at least pick up the pieces of the puzzle and continue on monitoring your program appropriately. That includes ongoing training. We talked a lot about that. For sake of time, I won't bore you with more training, but it's critically important. Again, and the technology piece is important for your BSA staff to have in order to conduct that audit trail effectively and efficiently, create some efficiency so you're not running all of this process manually. And perhaps one of the most important parts is the FinTech business evaluation. What's their business model? What is it today? Who's your target market? Value proposition? What's their revenue streams? Who are their competitors? What are some potential regulatory challenges that are maybe not present today, but maybe coming down the pipeline? That's going to tell you whether today and long term they fit your risk appetite. Who is their staffing? What experience do they have? You should have access to turnover rates too. What's their staffing and contingency planning look like as well? Because they may be all smiley and look great on the surface today, but tomorrow everybody could get mad and walk out the door, and you have a whole different problem on your hands, because the money's still flowing, but nobody's watching it on the back end. Capacity and scalability. What's their staffing look like? What is it in regards to the workload? If they want to have 2,000 clients in 4 months, that's great, but they're not going to do it with just one John Smith in the chair, potentially. You need to be able to say, have you thought about what's your triggers for hiring additional staff, and what's the capacity that trigger is going to occur? Team stability and continuity goes back to having access to employee turnover rates. What's their retention strategies? Succession planning all includes in that. Collaboration and communication goes back to having that open line of communication. How are you going to communicate with any concerns? How is all that going to be documented and memorialized? And then setting those expectations with that FinTech to begin with. And then lastly, we are going to aggregate all of the ratings down here and to understand what your residual risk ratings are, and then write a clear and concise statement down here about what your conclusion is, and ensure that that is circulated amongst your key stakeholders, including the board of directors, and that any communication you have is being thoroughly documented so that you can ensure that you have coverage yourself from the perspective of what should be there to mitigate all those risks to your institution. Anything to add on, Brian?
No, it's just so beautiful.
Well,
All right.
any questions?
I know one question that we had received was earlier about the guidance. And so the OCC guidance on this, the third-party risk management guidance from 2013, that's bulletin 2013-29. And then the FinTech specific guidance, which is really, in my opinion, just a ripoff of 2013-29 with some fancy new words added to it, is bulletin 2021-40. Either one of those are going to be very, very helpful there. I'm also just going to show you guys really quickly the FinTech ROI calculator. So let me share that.
My gosh, I manipulated the whole time.
No worries. In general, I mean, this calculator, it's helpful, it's a good starting point, but these relationships are so nuanced that it's probably not going to work perfectly for you. So if you have a FinTech relationship that you're trying to determine, like, what's the profitability of this for us, feel free to shoot us an email. I'm happy to help you tailor this a little bit to the specific relationship that you're investigating. Just to give you an idea of how this would work starting off, the assumptions page is going to be here on the back. You'll be able to put the number of customers you potentially would have, the potential balance you'd expect from that customer, the types of fees you would charge based on their complexity, and then your net interest margin, potentially customers you'd gain in terms of scaling, if it's fast or slow. And then lastly, how much do you pay your staff? So all of that will get rolled in here. If you change that risk profile to really whatever you want it to be, low, medium, or high, this will adjust for the amount of time that it takes to manage that sort of relationship. And it'll show you down here what your expected profitability would be in the different ways that you were to operate the program, whether that's using RiskOut, whether that's using it by yourself. I am a giant nerd when it comes to Excel and building these calculators. So I really mean it. If you're trying to build something here and you need a hand with it, or you just want some idea of a better way to model the way that you're going to be going to relationship, please just shoot me an email.
All right. Well, if there are no more questions, I cannot believe that I forgot that you needed to go over that ROI calculator. So apologies for risk assessing us all to death. But
you see that speed though? That's how you manage risk. I know there was another question in here. So Kristen, one we have is, if a bank chooses to exit a relationship, what are we seeing in terms of the time that takes for unwinding a relationship? And then the second part of that would be, does the FinTech have to find another financial institution?
Yes, they do. For the second part of the question, they typically do. So the wind down period can be for varying reasons, right? You could want to exit it because of something egregious, and then you just cut their legs off and that's it. And that is pretty rapid in movement. Most of the time there's a good wind down period of at least 2 or 3 months, so that FinTech has time to go find another financial institution. And maybe you have them wind down a lot of the activity, maybe freeze any additional customer onboarding on their side, and that usually will move them along a lot more quickly than if you let them continue to operate as business as usual. But yeah, the exit strategy typically, unless it's something egregious and you guys are just like, forget it, you're gone, is usually about a 2 to 3 month wind down period.
Yeah, and I think an important aspect of that is clear and decisive action. You have really kind of those service level agreements in place where you're saying, in this event, this is why we terminate the relationship. This is the process for us terminating the relationship. So everyone knows how that's going to go. Typically, the way these companies are built, they're built for growth. They're not built for a wind down. So just keep in mind that the technical feasibility of that is going to be slower and probably a lot more complex than the onboarding piece of things.
Certainly. And it's not a fun event.
No.
It's not, you know, because it ends up, the FinTech becomes a lot more tangled in areas than maybe you initially realize. And so there's a lot of, every department should be involved in that unraveling of that relationship, because what you're thinking of in your department, you may selfishly be thinking of, you've got your stuff, this relationship is fine to offboard, but it's certainly not, because there's consequences over here that need to be unwound first. So be cognizant, be mindful, be methodical about it.
And then last question, Kristen, or like it's the last one we have time for, is I'm gonna summarize. Typically, FinTechs only have to file SARs if they're registered as an MSB or some other licensure that requires them to have a BSA program. Is that true?
Can you repeat that? Sorry.
Basically, our FinTechs typically only required to file SARs if they're registered as an MSB or registered in some sort of fashion where they have licensure that allows them to file directly with FinCEN.
Are we seeing that often, or it's just a mixed bag? It really is a mixed bag of if they are supposed to be registered as an MSB, then yeah, they absolutely, it's almost you're operating a big MSB program at that point, right? And you're ensuring that they are doing what they're stated doing, the money movement looks normal, blah, blah, blah. But they do have the ability to direct file with FinCEN, and you know, their limits, their thresholds for filing SARs are more sensitive than an institution's thresholds for filing SARs, and CTRs for that matter. So yes, the answer is yes. If they are supposed to be registered, you know, essentially as a money service business, then yeah, they do have direct file capability, but you should still be ensuring that they are actually filing, that they know how to detect illicit activity.
Yeah, and to add to that, I think there's a lot of FinTechs that I've seen where I was surprised that they have some sort of licensing that I didn't expect, particularly like wallets, things like that. A lot of them will be registered as MSBs where they will have that responsibility. And then to Kristen's point earlier in the webinar, the investigation piece for identifying suspicious activity, that might just be a process where that reports up to the financial institution validates and then files. But if the FinTech has that ability to file the SAR, then they're more than likely doing it themselves. And if they do not have the ability, they're pushing that up through the financial institution, so the financial institution can communicate that information in line with what their regulatory responsibilities would be.
We could talk about this stuff for the next week and a half, but you know, with all of these nuances, and so if you guys have any specific questions you just want to shoot over to us individually too, if we didn't have time to answer your question, feel free. Our emails, I believe, well, I'm not even going to try to share my screen again because that's always a disaster, but you know, you can find us at both Ryan and I's contact information on the information that will come in the follow-up email, but also we're on LinkedIn, and you can go to riskscout.com and find our contact information through there as well. So
yeah, it's a pretty complex naming structure for the emails with Kristen at riskscout.com and Ryan at riskscout.com, but I feel confident.
I could have just said that, I would have simplified it, but you know, BSA people can be, sometimes you gotta overcomplicate it. So, all right. Well, on that note, I hope everyone has a wonderful day. Thank you, Ryan, for co-hosting with me, and we will hopefully be talking to you guys soon. Thanks.
Thanks, everyone.